Hey guys, how are you? Everybody can hear me okay? Just stay with me for just one sec, guys. I'm sorry, I just got to set some up here. In the meantime, feel free to post up any questions that you guys have. We'll talk a little bit about anything that's going on in the market. It's a really, really boring day today, so we have plenty of time to discuss stuff. All right, tell me if you guys can see a picture of Tommy Schlossberg here. So everybody, I just want to make sure everybody's seeing a picture of Tommy Schlossberg. Do you see a picture of a magazine interview? All right, super. All right, I'm going to just see if I can. This is the link in Think Money magazine. Interview with Tommy Schlossberg. Everybody who trades should read this interview because there's so much interesting stuff inside of it. And I wanted to start off our session today with the conversation about what Tommy talks about, because I think even though he himself trades FX very, very sparsely, everything he talks about I think is incredibly important to us as retail traders. Now, Tom Schlossberg was a veteran of the Chicago Board Options Exchange. He used to be a market maker. He is the creator of Thinkorswim, which I'm sure many of you who are in North America know is it's one of the leading option platform providers in the world. Anybody who watches CNBC knows Thinkorswim ads. He's the guy that basically created the whole company and then sold it out to TD Ameritrade. Very, very smart guy. What makes him so great, and I've known him for a very long time, is that Tommy is not just a business person, but he's actually a trader through and through and through. He trades every single day just like I do. He puts his capital to work. So when he talks, it's really somebody who's talking from experience, not somebody who's just pontificating without any true knowledge of the market structure and marketplace. And what I found so interesting about his interview here, and this is particular, this is the particular area where I kind of wanted you to focus on, is I'm going to actually read this to you because I think it's so important. It says, what wisdom do you like to share with small investors or new traders? And Tommy says, stay small. Most individual investors trade too big. Second, diversify your strategies. Professional traders and money managers do it all the time. How they spread capital around between 1 or 100 other positions is something small traders can learn. So what he's talking about is that basically, and let me just read the beginning of this also because I think it's really, really important. He says, I use the example of a Las Vegas casino. Why do tables have maximum betting amounts? The casinos know that on any single hand in a single game, the probabilities may or may not work in their favor. They don't want to have one enormous bet wipe them out. Their probabilities work best over millions of smaller bets in games where the odds are in favor of the casino. If the probabilities don't work out on a small bet, it's no big deal. Today, investors and traders have to think like casinos. Casinos don't gamble. They let probabilities work for them over many small bets. This, I think, is one of the most interesting and insightful points that anybody who trades for a living needs to absorb. This is so, so crucial. And it's not that Tommy's talking about comparing trading to gambling. What he's comparing is how businesses like casinos operate, how really all good businesses operate, and how you as a trader should operate your business, which is that instead of taking huge bets on 1 or 2 positions and basically risking the blowout every single time, or perhaps even winning 10, 12, 20 times in a row only to blow everything up on the 21st trade, the true intelligent way of trading over a long-term period of time, over a way of making consistent and I would say repeatable profits over a long period of time, is only by doing what casinos do, which is taking extraordinarily small bets. Now, those of you who know me or who've traded with me before, who've sort of followed everything that I do, know that my domain of expertise, what I pretty much focus on a day-to-day basis, is the intraday market. Ask me what a euro goes, I have no clue. I don't know if it goes to 130, I don't know if it goes to 125. I can give you reasons for both sides of the equation, And, whenever I go on CNBC, I'm very good at sort of, producing long-term trends. Occasionally, I'm actually even right. Occasionally, I'm wrong. But the point is, I have very little confidence in whatever I'm prognosticating because there's so many different things that can go wrong. But where I do operate and where I do think I have a degree of confidence is on a shorter-term time frame, because just like with the weather, I really couldn't predict to you if New York is going to be rainy or sunny this Sunday. But as I stand here right now on a beautiful sunny fall day in New York City, that in the next 2 hours when I have to go out somewhere, I'm pretty confident I'm not going to get rained on. So I'm pretty confident that sunshine is in a momentum mode. And so I'm going to be trading long sunshine for the next couple of hours. And that's effectively what I kind of do in the currency market. I look at opportunities in the currency market to trade the continuation of momentum. Now, does it always work? Of course not. Does sun turn into rain all of a sudden? Of course. Do you have freak weather patterns happening sometimes where it's sunny one moment and it's rainy the next moment? We just had one this weekend. My wife was at a Madonna concert and everybody got completely stoked because of the rain. So of course, that's the whole point. If every day was a sunny day, we'd all be billionaires by the end of the year, right? The point being is, what you try to do is capture more sunny days than rainy days and do it in a small enough amount that it over time adds up in your favor. So that's the crux of what Tommy was saying, and I hope you guys understand what is the underlying thesis for how I trade, which is very, very small amount of trades or very small size trades, lots and lots of those trades, and hopefully with a positive edge. Now, the other thing that he brings up in this article that I think is kind of interesting is diversification. Now, in the currency market, we don't really get to diversify that much. It's not like stocks. We have a universe of 6,000 stocks that we can look into. We only have about 8 main currencies that we trade. But even 8 currencies is quite a lot of diversification. Most of you, I'm just curious, how many of you trade more than 2 currency pairs on any given day? Just give me say yes, you trade more than 2 currency pairs. How many of you? Just punch in yeses in your chat boxes. Right? All right, so far I see there's 55 people in the room. I see like 4 or 5 yeses, which means that the majority of you probably only trade 1 or 2 currency pairs, which is okay. That's fine, but understand what you're doing. You are concentrating all your risk in one particular domain, in one particular strategy. And what Tom is advising, and I think it's a really intelligent advice, is what I've started doing, for example, is instead of trading, I don't know, let's say my average size is 200,000, right? Let's say my average size is 2 standard lots on the euro, right? Instead of trading 200,000, I'm going to trade 50,000. I'm going to trade 40,000 euros, but I'm also going to trade 40,000 euro yens. I'm going to trade 40,000 euro Aussies, and I'm going to trade maybe 30,000 pounds. I'm going to trade more pairs with less size because that's going to give me, if I'm trading a strategy that makes sense, that's going to give me more opportunities and it's going to diversify my risk. Now, does that mean that I'm going to hit 5 in a row? Of course not. I'm probably going to miss, 1 or 2 of those trades. But over a long period of time, what I'm going to be able to do is do 2 things. I'm going to be able to take more trades. Hopefully, if I have an edge, they're net positive. And more importantly, I'm not going to be stuck in this is a situation that I think many of you who've traded have seen. Let's say you have a good strategy, right? But the strategy hits a very bad market environment. Let's say you have a strategy that's a breakout strategy and the market environment is just continuous stakeouts. So you have 1 miss. The next day you have 2 misses. The third day you have the 3 misses. The fourth day you have 4 misses. And sometimes you even have 5 misses in a row, right? So how many of you, I'm just curious, how many of you have been in a strategy that is good but that destroyed you during a month or a particular week and made you really doubt its value? Just punch in yes if any of you have been in that situation. Right, often, right? Often. I mean, I think all of us have been. Anybody who's traded for a while pretty much knows that is a serious danger of relying on any particular strategy. So when you diversify across a currency set as well as a strategy set, you tend to mitigate that type of a scenario. So you're still going to hit 5 negative euro trades in a row, but maybe some of them will be offset with positive pound trades, and maybe some of them will be offset with positive euro-yen trades or euro-Aussie trades. And that overall dampens your drawdown, which is really what you're trying to do. I've always been pushing this point. The most important thing to learn from Warren Buffett isn't about investing. It's all about money management. Warren Buffett said one thing. He said, number one rule of investing is not to lose money. And the number two rule of investing is to remember the number one rule. And my point has always been that when you look at all sorts of strategies, and I've gone through, God knows, countless strategies, the single best way to make sure that you're making money and the single best way to improve that you're making money is to try to lose the minimum amount of times, is to improve your losing. So it's inevitable we're all going to hit losing streaks, right? The critical thing is to make the losing streak as small as possible by diversifying in this particular case, which is the strategy that Tommy really advises. And I see that Fernando agrees with me. And that is really the critical thing. You cannot avoid losses. All you can do is try to minimize them as much as possible. And it's much, much, much more important to minimize the losses than to push for wins. So Philip is asking, what's a good win rate for a trend trading strategy? I have no idea. First of all, I don't know what a trend trading strategy is, because one day's trend is another day's reversal, right? I've never understood. Show me a trend in real time, and you'll be a genius. Show me a trend on the back chart, and anybody is a genius. I just don't, 2 weeks ago, could anybody have said Euro is going to be in one of the best trends of this year because things are just going to be so hunky-dory, it's going to be the single greatest opportunity for anybody to get long Euro? Now, how many analysts said that to you 2 weeks ago? And more importantly, the one guy that may have said it, how many times has he been consistently right on picking those kind of trends? I actually think it's impossible to pick a trend beforehand. It's really, really, really easy to pick it behindhand. So the question isn't so much what's a good winning rate for a trend trading strategy. It's really a question of mathematics. How much do you risk? How much do you risk? How much do you try to profit? And what is the proper rate of accuracy you need to have in order to break even? It's really a matter of risk and return. It's exactly what Z-Salt is saying. Now, I trade negative risk-reward strategies. I'm going to share with you some absolutely crazy negative risk-reward strategies with you today. I mean, insane things that under any normal circumstances should be banned for even showing them to you because they are incredibly negative. But I think they're interesting, and I think they're worthwhile just exploring. Certainly, I've been using them myself in a very, very small size because I find them to be valuable and net accretive. I find them to be, so far, net positive. But the point is that if, like, for example, if I'm risking 50 points and I am winning 30 points, my target is 30 points and my stop loss is 50 points, then I need to be 65% accurate. I need to win 2 out of 3 times in order for that strategy to be viable. And that's really the critical question you want to ask yourself is, well, over a period of 100 trades or over a period of a couple hundred trades, has this strategy been 65% accurate? If it has been or better, then you have a legitimate strategy that may be worthwhile trading. And that's really how you want to look at it. It's not so much as to something is trend trading or something is mean reversion. It's much more the question of what does the strategy do given the risk-reward parameters I'm giving it? Is it legitimate? Is it viable for me to try it going forward? And then, of course, the very, very important caveat that every trader must understand is that past performance is never a guarantee of future results. As a matter of fact, very often you backtest something that looks really good on backtesting, and then the environment of the market completely changes, and the environment of the market that you had tested it on has stopped working, and the whole strategy could really backfire on you. That's another reason why you want to trade a couple of different ideas. But more importantly, it's also the reason for why you want to understand why certain strategies succeed and why other strategies fail. What makes a strategy work? Now, the strategies that I'm going to share with you today are all momentum-driven strategies. So if the market suddenly stopped having momentum, if the market suddenly stopped having continuation, none of the things I'm going to show you will have any value. In fact, it'll be the biggest disaster for you to kind of take these strategies. So you need to understand that ahead of time. What makes a strategy work, what doesn't make it work. And you need to assess if you're generally in a market environment where that's going to work or not work. Looks like we're having a little bit of a rally in the euro right now, which is nice, because we've been kind of dead as the day has gone by. So, Trying Trader is asking me, would I exit a losing strategy before it reaches my stop? The answer is generally no. And the reason why I don't exit a losing, let me preface that. If I am trading discretionary, in other words, if I'm taking sort of a flyer of a trade, and I don't have a strategy, I just sort of I like this trade because whatever, it looks good technically because I like the trade because there's a fundamental flow behind it. I like the trade because I'm just bored and I want to trade it. And the trade is not working out, and I always obviously have a stop on my trade. I may stop myself out, before it hits my stop. I may even reverse myself if what I'm trying discretionary is just not working. But if I'm trading a trade that is a defined part of a highly rule-based strategy, I do not stop myself out. Because the moment you do that is you destroy the whole risk and reward and return strategy. Because yes, perhaps you're going to get stopped out anyways. But there are plenty of times where sometimes something comes into within 2 or 3 points of my stop within my strategy environment, and then it reverses and goes all the way to my profit target. And if you screw around with that parameter, then you are really, really making a big mistake. The way to change things is not in the middle of a trade. The way to change things is in the strategy itself. If you don't think the strategy is working, then you modify the strategy. But you don't modify the trade. You let the trade work itself out, because any single trade really doesn't matter. And the moment you begin to get involved in any single particular trade, you've just done it completely wrong. We're having a conversation here between Mike and Boyke about the fact that I guess he's watching the screens for about 4 years already, which is, I think, a pretty legitimate metric. It takes good 2 to 3 years of watching screens before I think you get even a modicum of confidence and competence in being able to trade this well. So I think you really do need a lot of screen time before you get comfortable with understanding how markets really trade and how things move around. So anyways, we don't have too much time. I sort of set you up on the kind of structure that I think is very necessary for anybody who wants to trade on an intraday basis. Now, give me just a second. I want to start. I'm going to share with you a all right. Let me make sure. Does everybody tell me if everybody sees the chart of the euro dollar? Yep. Everybody sees the chart of the euro dollar? Okay, great. All right. So I'm going to get rid of these lines. And all right, bear with me. I just gotta rearrange my screen here so everything is comfortable. Okay. So I'm going to show you an absolutely crazy momentum strategy, and it comes with full warning that it's a horrible risk reward, that it's really not what anybody teaches you properly, but it's something that I've been trading myself, and I think it's kind of very interesting to consider, especially on the euro complex. And the idea basically is the following. Those of you who are familiar with my flow strategy know that I basically trade my flow strategy between the hours of 4 a.m., so 4 a.m. New York time, this is all New York-based charts, to the hours of about 11 a.m. New York time, the prime liquidity hours. Excuse me. This is when momentum has the highest opportunity to occur. Momentum has the best opportunity to happen, and when we have continuation or strong reversals that can generally give us the extension that we want. And those of you who know me generally know that we trade the round number moves. That means we try to basically take the move from the either 55 from over here from like the 5,500 all the way down to the 00, right, to the 00 level, or occasionally I'll take the moves from the 00 level down to the 55. But what I do with my strategies is I generally have a 30 to 33 point target and a 50 point stop. And as I said to you, if you're 65% accurate, you're generally going to do okay. But one of the interesting things that I found that I think is kind of really interesting to examine is if you just look at the round numbers during these high liquidity times, that is the 2,300 in this particular case, or the 2,300 back here again, 2,300 back here again, 2,400 back here again. If you look at the 00 numbers and you look at the breakthrough those numbers during the high liquidity times, if you give yourself a very, very small profit target of just 15 points with a really, really large stop of 50 points, again, a horrible risk-reward ratio of 3 to 1, what happens is across not just the euro, but the whole euro complex, euro Aussie, euro yen, even Aussie dollar, you have generally really high probability trades. If you're risking 15 to make, if you're risking 50 to make 15, you have to be correct 8 out of 10 times. Chart is on, right? You guys see the chart? You have to be right 8 out of 10 times to win. But what happens is you tend to be very accurate a lot of times. Here's a chart of the euro dollar just for the last couple of days, where you can see a break of 2,300 with an 85 stop would have worked. A break of 2,300 here in the high, again, only in the high liquidity times would have more than worked. A break of 2,300 again in the high liquidity times would have really worked very well, right? But what's cool about this is it's not just the euro. It's also, I think, works very well on the pound, which is one of our like biggest nemesis. Let me just pull up the pound. So we can look at the pound during the high liquidity times, which is the 5,700 over here, right? This is 7 o'clock in the morning New York time. 15 points would have worked, right? If you look at this is 4 o'clock New York time, so it really doesn't really apply to us. But this is a move in the 8 o'clock hour back to the 5,700, and the high here, as you can see, was 18, right? Well above the 15 would have worked for us here. Here's a move into 5,700 that would have worked here. What's interesting is if we move to the really, really big numbers, this is not high liquidity time, so we wouldn't have taken these trades. But can you guys see the chart, by the way? I'm sorry. Does everybody see the charts? Okay. All right, because I'm seeing people putting questions. I wanted to understand. So I wanted to show you, like, here's a really, really interesting point. This is the high liquidity of the 160 move, right? Now, in the 59, it would have worked here on the plus 15. In the 160, I believe there was a move right here. No, did it tick me out? I'm trying to remember. There was one where it didn't work well on the pound. Actually, the pound was really working very well across almost all of these. Well, here's a move. No, even here. Okay, so here's a move to 159. This was a move to 159 where it didn't quite make the target and it failed. But it moved. It made 59 target here. It made the 60 target here. It made the 58 target here. And you guys basically get the idea. Dirt Salesman is asking a really great question. He's asking me, am I doing this as in a retracement mode, or as a continuation when it reaches a round number? And the answer is, always, 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 always on the continuation mode. Every one of my strategies are what's known as stop entry. I'm always entering my buys above the market, my sells below the market. That means I want momentum on my side. I want the price to blow through my target. So I'm never buying down and I'm never selling up. I'm always selling down and buying up. That's why I'm only giving myself 15 points of continuation, because as you can see, it's already a lot of momentum. I'm just trying to ride the wave, and I'm trying to collect, which is what I think Mike was talking about here. The idea of collecting nickels all day long. You collect nickels. So basically, the whole idea is you're collecting 15 cents, and then sometimes you drop half a dollar. You collect 15 cents, and you drop half a dollar, and you hope to collect a lot of 15 cents, especially across a lot of different currency pairs where this occurs on small size. So as I said, if your regular size is 200-300, let's say 100,000 euros, then maybe you cut it down to 50,000 euros. And I'm generally using this with the OO numbers. I didn't say 55. I said OOs. Zolt is saying, so if I'm making 10 trades, you'll be positive 20 pips. Well, I think you're up. Yeah, you're right. It is positive 20 pips on 10 trades if you're 80% accurate. What has been happening, or at least in my current trading, and again, no guarantee this continues to happen, is that the edge is actually closer to 85, 87. So the edge is actually close to maybe 30, 40 pips per 10 trades. If you can get anywhere there, that's nirvana. I mean, if you're making 30, 40 pips every 10 trades on an intraday basis, you're doing really, really well, because that's how it adds up over a long period of time. So yes, it's a lot of this kind of, you're basically picking up a lot of nickels along the way. You're like like an explorer who walks the beach. Now, as I said, Try Trader is saying most teachers I've listened to will not agree with my risk and reward strategy. That's exactly the point. I told you it's absolutely crazy. I told you it's absolutely the opposite of what everybody teaches. It tells you it's exact. It's insanely skewed to the downside, which is why I gave you lots of caveats. And that's why I tell you that it's a strategy that you should examine, but not necessarily explore if you're not comfortable with it. I trade this way because the market is very difficult, and I do not believe the market gives you $2 for every dollar's worth of risk. I think if you're going to risk $1, the market is going to take $5 out of your pocket before it gives you $2. So you kind of have to give yourself different type of parameters. Now, Mike is doing a very, very different kind of strategy from mine. He does sort of like, he says his wins are average 3 to 10 pips, stop losses around minus 5 pips, and sometimes he closes manually. And it works in the long run because he's basically sitting here in front of the screen. Now, if you are point and clicking all day long, you may be able to match Mike. But I cannot do this because I, like everybody else, am super busy. I don't have the time to do the kind of trading Mike is doing. You need to have complete and total dedication to the screen and absolutely to-the-second execution of what you want to do. In other words, you blink, you snooze, you lose. I happen to snooze a lot. I have come to a long-term understanding. I will never be able to watch the markets with a kind of intensity necessary to be able to trade like Mike. So my strategy is designed for what I call a relatively normal day, where I want to be in the market, but I can't be in the market every single second. So that's why I set up all of my strategies ahead of time. All of my orders are in the market. I don't do anything instantaneously. My orders are preset. Mike is just one of the guys in the room who is posting. Okay, that's why I'm just responding to what he's doing. Okay, just read. What I'm responding to, Damon, is the feed that everybody's talking to. We're having a two-way conversation today between everybody who is in the room and me. So anyways, my point is that I cannot execute the way he does. He's working on a very fast execution program with a non-dealing desk broker, which actually, I do too, but I just simply don't have the time or the patience to be able to do this. So all of my entries are on stops simply because that's the only way I know I can be in the market at the right price, at the right time, with the right risk rewards for what I want to do. And that's why I sort of share these ideas with you, because I think for most of you, your day-to-day life is much more like mine than it is like somebody like Mike's, who's able to just completely watch the screen with the intensity of an X-ray technician that I just simply don't have. Yes, exactly. But Trader is saying you need to have a complete confidence that you'll have a high win rate and a lot of courage. I don't know if you need a lot of courage. You just have to have a lot of confidence. But I mean, here's the thing. If you are afraid to lose money, you will lose money. I think the whole idea of courage is nonsense. Not nonsense. It's a harsh word to describe it. I absolutely understand the fear of the new trader. I completely understand the paralysis that happens when you're clicking on something and, oh my God, it's going against me. Which is why the single most important thing that you need to do before you ever trade is learn how to use stops. If you don't know how to use stops, if you have never taught yourself the importance of stopping out of the market, you will never have the courage to trade. And learning how to use stops is like a 2-year process because it is so hard to accept being stopped out. It is so hard psychologically to lose money. And you need to get to a point where you don't give an S about it. That's a very, very hard point, in the life of a trader. But it's only at that point that courage begins to completely evaporate. Once you get to a point where you learn how to stop out, courage is no longer an issue because you don't care. It's business. It's not courage. So you got to get to the point where it's business, and the only way you can do that is by learning how to trade with stops. That's a completely different seminar, and maybe it's a seminar we could have one day in the future because I think it's a very important one. But in the meantime, one more question about the Zolta's having a question here on. He says, when the target is reached, then price retraces below zero and then goes again. Will I take it for the second time as well? No. Great question. I'm only going to take one trade per day cycle per the level. So, okay, when would I trade twice in a day? If the price goes from 2,700, I make a trade. Then the price goes all the way to 2,800 in the euro, I make another trade all within that time frame. Yes? No. If that doesn't happen, which is very rare, that happened on when was it? Last Friday, right? Otherwise, I will only trade one time per cycle per currency pair. This is another thing that you don't want to make a mistake in. You don't want to get, it's like you make your money, you walk away. The other single biggest mistake that traders make is they win a hand and they want to play again and again and again. And what do casinos know how to do? What do markets love to do? They love to keep you at the table. The longer you're at the table, the higher the probability you're going to give everything back. Right? What I say to you at the beginning of this session, the single most important thing in trading is not winning. It's not giving it back. So I have an ironclad rule. I trade once. It works. It doesn't work. The next day is I start everything all over again. Right? So Pacer is asking, Boris, do you think this sort of trading became necessary as a result of market conditions for the past 2-3 years due to algos taking more part in the market, lots of up and downs? Yeah, I think algos have definitely changed the market. I think you have to adjust and adapt, which is one of the reasons why I don't trade against the algos. As you can see, I trade sort of in what I think is the only way you can trade these days as a retail trader, which is by trading momentum, by staying true to what the market is doing. I think a lot of times what happens to my trades is that the algos are actually probably taking me up and taking me out of my profit of all my trades. I don't know if that's true or not, but I certainly don't want to be on the opposite side of them. I don't want to be trading for every 5 seconds. My trades take between 2 to sometimes 12 hours to accomplish. Sometimes they happen within an hour, but none of my trades are 5-minute trades. I don't trade in a 5-minute chart because that's the domain of the algos, and I don't trade against machines. And I just answered Philip's question. So I don't trade low time frames. I trade on the 1 hour time frame because that's where I want to be. You know, and as I said, my trades can take sometimes. Last Friday we had really good price action, so my trades took like 2 or 3 hours to develop. Some of them even took 1 hour. But generally, sometimes my trades could be as long as 12 hours, and sometimes you can be in incredibly slow price action like we are today, and I could be in a trade for like 24 hours. You know, like I'm holding right now a very, very small position on a short euro yen at 100. And maybe it's going to work, maybe it's not going to work. I don't care. It's a small position, but it could be a trade that could literally last until tomorrow before it finally resolves itself. And I'm perfectly happy. I don't care. I'm in the trade. The platform is holding my stops and limits. It's either going to work or not work, and I have a million other ideas that I'm working on. Oh, so Chuck is with me on the euro yen. Okay, yeah. So we'll see. We'll see where it goes. I can't say I have enormous amount of confidence, but I think the euro looks a little tired here. I think we have a lot of risk in front of the court decision in Germany, and if the price action took me into the 100s today, let's see if it continues to the downside on the euro dollar, on the euro complex. We'll see how it works out. So anyways, I'm open to any questions. We got about 5 minutes left, to the session. Any questions on the strategy? Any questions on the broad fundamental issues of the market? Any questions on your personal trading? I'm happy to answer anything you guys have in mind. Forex Club is transferring accounts to another competitor. I have no idea why. I don't know that broker, and so I would suggest you talk to them and find out. Maybe they got taken over by another broker. That's not a broker. It's not that I'm allowed to recommend brokers. We work with FXCM. FXCM is we're an IB of FXCM. We're in the process of getting registered right now. So as soon as we're fully registered, I will be recommending FXCM as our broker. Now Phil was asking me how many pips do I normally target. Again, it depends. In my general flow trade, I target 30 pips with a 50-point stop. But in this particular strategy that I showed you today, the sort of hyper crazy high, hopefully high probability strategy is a 15 pip target for a 50-point stop. So knock yourselves out. On the hourlies, yes. Boyke, as I said earlier, I don't know what trend is. Trend is what happened on Friday. Do we have trend today? No. When do I trade? Trying Trade is asking me, when do you know when a chart is not worth trading or there's no momentum? I would say you never know, but there are certain days that are high probability days of when things are going to move and when things are not going to move. So obviously, if half of Europe is on vacation and it's some bank holiday in England, the probability that you're going to have lots of movement is pretty minimal. I mean, the day before Christmas, you're certainly not going to have a lot of momentum generally. The day before Thanksgiving Friday, sometimes you won't have. On the other hand, I have seen Thanksgiving Fridays go nuts because somebody in the Middle East decided to go out there and buy a ton of euros. And you could have sometimes some of the greatest moves on those quiet days. Generally, I would say the pre-holiday times is when I don't trade. But other than that, you really don't know when things are going to blow up. Somebody's asking me about, our GFT FXM. For those of you who don't know, we left GFT on our own. We went on our own. We have our own website. Those of you can go visit it. I can't imagine anybody in this room doesn't know this, but I'm going to put up the DK Asset This is our website. We have our own business. we are no longer associated with any particular broker. We also have another website, which has been our Signal website, and you can find out more about our signals from the moderator right then and there. Feel free to sign up because a lot of these ideas are traded in the BK Forex signal services, and we're also going to, as soon, you get a 10% discount if you sign up through FX Sheet, which is really nice. And also, very, very soon as we get fully registered, anybody who signs up is going to get so much additional value that it's just going to be awesome. So I really highly recommend, if you guys are not members of the BK Forex Signal Club, it's going to be like 10 times more stuff for the exact same amount of money. So I hope you guys will join us. And for everybody who's already a subscriber, you're going to get everything, I promise you, and more so as part of the subscription. So we're really going to expand our offerings much more very, very soon. We're just waiting for the final ink to dry from the regulators. So anyways, yeah, so that's what it is. We decided to go on our own. So that's the reason why we left GFD a while back, in case anybody is interested. Anyways, my time is running short. I unfortunately have to pop away because I got a media interview I got to get to. I hope you guys found this really interesting. I think this was a really, as I said to you, this is something I trade live. Everything I discuss with you guys, I always trade live. None of the stuff I show you is academic. So I hope you guys enjoy it. Give it a shot across. Like I said, lots of currency pairs, lots of currency complexes with very, very small amounts, because I think that's really the key. That's the lesson of the day from Tommy Schlossberg, who is a much better trader in many ways than I am, and I wanted to bring it to you. And then we can, in the next couple of sessions, I will be, of course, in Las Vegas this week, so anybody who's coming to Las Vegas, please come join us. I'm going to be talking about the value of technicals and fundamentals, and then next couple of months, maybe we'll talk about the idea of the importance of stops and how do you teach yourself how to take stops properly. So hopefully we'll discuss that. And also, by the way, at FX Flow is my Twitter. Hit me up on Twitter if you have any questions. If you have ideas for future webinars that you want to see, please put me up there. I always respond to everything that you guys send me there. It's the best way to get a hold of me, okay? All right, guys, I'm wishing you guys the best of luck and the best of trading. It's going to be a very interesting week. While we're quiet right now, the only thing I can pretty much assure you is we're not going to be quiet for the rest of the week. It's definitely going to be a hellstorm. Thank you so much for attending, and I'll see you guys next month, and hopefully I'll see some of you guys in Vegas. All the best to you. Talk to you soon. Bye-bye.